There's a few fundamental things that I found as to the reasons why people don't build a multi-million dollar property portfolio. And I know the title sounds a little bit negative, a little bit daunting, but I'm going to highlight what I see as the obstacles, and then at the end of each obstacle there's a tip so you can see how to overcome. And I think they're quite straightforward to overcome. But there's a bit to get through, so if there's any questions and they're hard, keep them for Ben and Kate towards the end. If they're nice and easy, I'm happy to take those ones. Okay, so what we're going to discuss today is we're going to have a quick look at the facts. But just by a quick show of hands, who is already a property investor? Nice, easy one to start with. Who isn't yet a property investor but would like to be? Okay, and hands up those people who won't answer any questions I ask, irrespective of what it is. The ones who won't give me eye contact, I know who you are. I'm coming for you. So we're going to look at the facts. We're going to reveal those 7 obstacles and have a look at what the tips are to overcome them. And then we'll start building. But what I want to show you is, what I find is, if you read a lot of the magazines, there's a lot of media that suggests that people have got heaps and heaps and heaps of properties. Now, I'm very lucky to follow Kate. She's someone who I admire in the marketplace. She's a very, very good buyer's agent. She's got a very good blend of process and intuition. But she does have quite a significant portfolio. But what I found is that, in the circles that I mix in, largely being involved in this industry, you meet lots of people in a position where they do have multiple properties. And it's quite easy to think that everyone does. And if you have a look at the magazines, 110 properties, 86 properties, 23 properties in 23 months. I mean, it just seems like everyone's doing it. But the reality is, here's the facts. This is from the ATO, that of the very small percentage of the population who actually do invest, 7 out of every 100 people in this country put their hand up and say, I want to be a property investor. 7%. Okay? And of that very small number, a very large number, 7 out of 10, stop at 1. Interesting. Because if you read the magazines and you talk to the people that you bump into in this industry, you'd think that everyone has more than one. But the facts are 73% of the population, and this is measured by the Australian Taxation Office, who measures your tax returns to see who puts down that they've got rental properties. 73% stop at 1. And it's 91% stop at 1 or 2. So the facts are not many people do. And I found that fascinating, and I thought, well, why is it that most people don't get to a position? There are a select few, let's be honest. Has anyone in the room got multiple properties, put themselves in that spot? Yep, Monique. There are people that do have multiple properties, but the facts are it's not the majority. So let's have a look at some of the reasons perhaps why. First one is, I think that it's quite easy to treat property investment as a hobby rather than a business. It's a very large asset class in this country. It's about $3.4 trillion. To give you a comparison, the share market's about $1.2 trillion. It's a highly emotional and opinionated asset class, and because we live in one, it's easy to think we're qualified to determine which one makes a good investment property. But the reality is, and Kate would tell you every day of the week, that not every single property makes for a great investment. And I think that is probably one of the hardest things to realise, that there is an art and there is a science in knowing which property to select. So it's true that it is about bricks and mortar, but it's also about finance and structure, investment strategies, demographic trends, property management, capital growth, yields, debt management and cash flow. So there is a lot that you need to consider as a property investor. It's not easy to build a multi-million... in fact, it's simple to build a multi-million dollar property portfolio, but it isn't easy. Okay? So the goal here is to master all aspects and surround yourself with a quality team. And the key here is that time-poor people still master property investment. They just outsource it to people who know what they're doing. And they just continue doing what they're good at doing, bringing in the income into their household, and then use their money wisely when it comes to investing. So it's important to know that property investing is actually a process. And what I find is, Ben will talk to you about this at great length later on, but we've broken it down into a 5-step process. And if you follow these 5 steps, it takes a bit of the mystery out, takes a bit of the mystique out, and it makes it very, very palatable how you can actually get multiple properties. But the first step is to clarify, and that's collecting your information and then setting some goals around that. The second step is to evaluate, and that's to have a look at what your situation is and what is the best opportunity given your strengths and your weaknesses. And I guess the easiest way to remember this is if you go to a doctor, I speak at a lot of the expos around the country, and I generally find that someone says, look, I'm under this roof, how do I know which of these companies is the one that I should be chatting to? And I say it's very simple. Go up to them and ask them this very simple question: what's the best property for me? And if they go, I've actually got a brochure, this is a very good property for you, I say walk away really, really quickly, because it's like going to a doctor without saying a single thing and they write a prescription and say that's what you need. Everyone's different, they haven't asked you any questions. It's important to collect the information, analyse it, and then assess what's actually going on. And then the third step is the plan. And I think it's fundamentally the most crucial part, and it is the very reason that I'm incredibly proud to be involved with Empower Wealth. They have the planning, modelling that is second to none, and it's something that I think is a real gap in the marketplace in terms of how people can project how property investment can work for them. The fourth part is the implement. That's the bricks and mortar. That's the actually going out into the marketplace and finding the real estate. So finding it and then being able to deliver. And as Kate said in her presentation, it's not just a case of looking on the net and deciding which property that you want. There is some, I guess, some process and some skill in being able to acquire it at a great price. And the last part is the review, the managing and the monitoring. I remember having a client in Sydney, and she was a air hostess. She would travel from Sydney to Hong Kong to London. Every second weekend she would stay in London and then fly back home that same way. She was on about $100,000. She bought a 2-bedroom apartment in Harbour, which was in Sydney's northern beaches, and she bought it about 9 years ago. And her plan was to buy one investment property each and every year. And so when I met her, it was last year, so 2011. It was about 8 years down the track. So given that was her plan, you would have thought that she would have had 5 or 6 or maybe 8 investment properties. So the first question was, how many have you got? How many did she have? 1 investment property. Why? Because she didn't get around to reviewing. She didn't get the time. She was having a great time. She was earning wonderful income. She was having a great lifestyle and never got a chance to actually buy some more. Interestingly, she paid off the debt, so no tax deduction. So there's an opportunity lost there with all of the tax that she was paying. So there is a process. Property investing is a process and not an event. Number 2, and this is very much leading into what Kate was saying, the media hype. There's been that many reasons for not buying or actually adopting a wait-and-see approach in the past. There was the oil crisis, the floating of the dollar, the stock market crash, the recession we had to have, the Gulf War, Sydney Olympics, September 11, and of course the GFC. I remember I got involved in property investment back in October 1998. And I bought my first investment property in 1999. And I remember at the time we were helping investors buy properties, and every single property that they purchased had positive cash flow. Every single one. And I remember when the GST came in, there was a point where people were going, we did our calculations, and there was, people might have to pay $2 or $8 or $16 a week to fund these investment properties. And we just thought that was the end of property. No one will ever invest. And of course, 2000 came and went, and of course, people are investing, and now you just flex. As much as you shuffle in your chair to get more comfortable, that's the same thing that happens around property investment. People shuffle and they look for the strategy that works for them. So there's always been a reason, but what impact has that had on property? This is, oops, we must have put the other slide in. Well, I can tell you that back here, they had the oil crisis, you had the floating of the dollar, you had the Sydney Olympics here, you had September 11, we had the GFC up here. So the point here is that there was no monumental crash. Now, if you have a look at the moment, there's been a bit of a correction. It's dropped about 8.3%. So I think that actually, this is Melbourne, by the way, so that provides you with some good opportunity because there's a bit of preemptive accumulation that can happen here. But you can see the overall trend in Melbourne has been an upward trend, and there's been no significant downside to property. Now, so that, I guess, lends the argument that if the media have got it right, why isn't that reflected in the results? So, interesting. Oh, there it is. Thank you. So plan for negative headlines, factor in a contingency for short-term fluctuations. Remember, today's news is tomorrow's fish and chips. If you plan effectively and you have a cash flow buffer in place, there's no reason that you have to absorb some of the media propaganda. Obstacle number 3, see Australia as one big market. I'm born and bred in Perth. My first investment property was in Perth, and now I've invested across multiple states. But it's quite easy to look through the microscope and see that your backyard is the only place to be investing. But if you can see that Australia doesn't move all at the same, you know, I remember my property over in Perth did very well through the Perth boom, and at the time Melbourne wasn't going so well. And so you could see that if you can move your money around in different cycles, you would have really maximise the opportunities that you had within your portfolio. But the interesting part is there's hundreds and hundreds of submarkets within this country, and then there's submarkets within those submarkets. So if you just think, you know, pick a suburb of Melbourne, there's the 3-bedroom house market, there's the 1-bedroom apartment market, there's the 2-bedroom apartment market. It makes general commentary at times very irrelevant. So I always say to people that it's important to focus on your local conditions. If you own a property down in the peninsula, do you care if the Melbourne market is flat as a headline? The answer is no. All you care about is what's happening within a 1 kilometre radius of your particular property, because that's what the valuer will use when they're assessing the property. According to the housing industry of Australia, there's over 8.6 million dwellings, 15,000 plus suburbs, and about 2,500 new dwellings coming onto the market each and every week. So to give you some context, there's about 2,200 listed companies on the Australian Stock Exchange. So when they're talking about general commentary around the share market, it's probably pretty relevant because of such a small number. But when you're talking about such a large number of real estate that no two properties are generally the same, it's important to know that the generalised commentary can become a little bit irrelevant. So do you care in Melbourne if the headline says it's flat, if you owned a 2-bedroom apartment in Elwood, which in the last 12 months dropped 10.43%? Or if you had a 3-bedroom house in Carlton, is in fact one of the only positive growth, double-digit growth in Melbourne in the last little while. So you can see that it's important to unpack some of this data and see what's happening in the local area and not rely so much on big statements. So I guess the point here is generalised commentary helps no one. It absolutely helps no one. What you really need to do is understand that what's happening in your market, what's happening in the area, and act with local conditions in mind. If you've got who's got a buy and hold strategy? Audience participation question. I won't maintain eye contact with anyone if you don't want me to ask you a question, but who has buy and hold strategy? Yep, buy and sell. Who's still not comfortable answering questions? A few of you. So the buy and hold strategy, who is the most important person in the entire equation? Crowd participation. No wrong answers. Silence. Who's the most important person in the entire equation? Me? Thank you. The investor? They're very, very important, but probably someone more important. Tenant? Tenant is exceptionally important, but probably someone more important. The bank? Well, close, getting close. It's not the bank, but it's someone involved with the bank. Finance advisor? Are you a finance advisor? The valuer. Who said the valuer? Your face is familiar. The valuer. Are you a plant? Did I give you that? I think the valuer is the most important person if you have a buy and hold strategy, because if you want to buy more property, what do? You go back to the bank and say, lend me some more money. What do? Send a valuer out to your properties. So it's important that you buy real estate with the valuer in mind, because the valuer is the person who holds the power. Because when they go and value your property, are they going to value it with other great owner-occupier style properties because you bought a really good one? Or are they going to say, this is a bit investment stock, I'm going to drop the value just to protect my professional indemnity insurance? So it's very, very important that asset selection is crucial. And so I think that the valuer is the most important person in the equation. Obstacle number 4 is don't understand how to afford multiple properties. I think there's probably 3 general categories that you can buy multiple properties. One is to tap into the family budget. Hands up those people who've got too much month left at the end of the money. Yep, too much months left. Generally speaking, no matter how much you earn, putting extra pressure on your budget it usually makes it unachievable for people to tap into their budget to buy more property. So for most people, that can be a challenge unless you look a little bit outside the square on how we can change that. Second one is equity funding. So you can use some of the equity that you have in your existing portfolio to fund a property. So let's say you bought one and it cost you 10 grand a year to hold, and you held it for 10 years, it's going to cost you 100 grand. And let's say it doubled. You bought a $500,000 property and it doubled to $1 million. In 10 years, you've made $500,000, right? And then you've had to use $100,000 of your equity to fund it, so you made $400,000. So that's a pretty good deal. But some people feel uncomfortable going into more debt to service debt. So that might not be the way for you. And the other way is to use some clever and strategic use of finance. And I would go into this in more detail, but Ben has got a very, very good explanation of this down the track. But Cameron, who heads up and is the director of our business and also heads up our mortgage broking division, does this stuff in his sleep, and strategy is a huge part for him. And so understanding strategy around finance and looking for ways to retire debt and freeing up cash flow so you can buy more properties is something he and his team are very, very good at. So that's another way to consider buying multiple properties. So you've got to get a property-savvy finance strategist, not someone who specialises in just buying homes for people, because there is a different skill set and there's a different mindset that comes from building a portfolio of property. Everyone still with me? Yes. Obstacle 5, don't keep future trends in mind. So in this country, the 19th century, we're a bush culture. You know, the swag man in sort of, by the river or in a country town. 20th century, it was a city culture, and that's how suburbia was born. We wanted to get as close to the city, but we wanted a quarter-acre block with the great Australian dream, which was a detached house surrounded by a garden with a barbecue and a hills hoist. That's what the plan was in the 20th century. But in the 20th century, things have changed. It's a lifestyle culture, largely driven by sea change, but also tree change, and opportunities to improve your lifestyle are really what's driving. So we've got to think about these things when we're buying real estate and make sure that we're buying into future trends. So the question, should I buy an apartment or a house? Does anyone think there's no money to be made in flats? Apartments? No one's going to answer my questions. I should move on. This is a generation graph. My father is a builder. My mother is a boomer. Generation X is me. My wife is Generation Y. And my son is Generation Alpha. So if anyone's got any kids around 6 to 9 and they want to lend that to me, then I can cover off all of the generations. But it's interesting at the dinner table to have a chat, because my dad, who was born in this generation, who was part of the Depression and part of father that was in wars, they thought pay cash for everything. But then you fast forward to Generation Y, or shall we say Generation Y leave home? Anyone got one of those? Anyone a kipper? Kids in parents' pockets eroding retirement savings. A few of those. So basically, Generation Y are different. They want the corner office straight away. They don't want to work up to it. They want any Generation Y in the room prepared to put their hand up. There we go. You know what I'm talking about. Would you compromise your lifestyle for position? Move further out, much further out. Away from your cafes, away from your friends, away from your favourite latte spot? Of course you wouldn't. You will at some point, but right now, no way. So there's situations where you've got two 25-year-old couples who live in a 2-bedroom apartment so they can be close to their favourite cafe near the train station. They can get into work and not waste any time. So it's important to understand a couple of things. Now, I know this slide has got a bit of detail, but at the moment, there's 36% of my mother's generation and there's 44% of my generation making up the workforce. That's 80%, 8 in 10. Fast forward to 2020, so if you're buying an investment property today, chances are you're looking around a 2020 timeframe. In 2020, for the first time in living memory, the baby boomers are not significant players in the workforce. They're 17%. Who would have thought? Baby boomers, they're like a basketball moving through a garden hose. They are prepared to change their lifestyle and now live spend the kids' inheritance, really have a ski holiday. But you've got the situation where Generation Y will be 35%. My generation will drop a little bit to be 36%. So the old land is what you need to buy is no longer king. Remember land, you've got to get land? The problem was it was never land that went up in value. It was always increasing demand, limited supply. That's what drove price. But Generation baby boomers, they wanted the quarter-acre block in suburbia. So that's what drove the demand. But now you've got a point where it's changed from land content to land value. So you can still buy the best property that you can comfortably afford in the highest land value areas if you're chasing growth, if you're chasing income, it's a totally different kettle of fish. But the old saying of land is what makes property go up in value has been adjusted. So the point here is don't invest with 20th century concepts in the 21st century because the market has changed. Obstacle 6, they don't buy the right first property. And have a look at the ramifications of that. If you were just to buy a $500,000 property, track its progress over 20 years, compound growth, have a look at the difference in the outcomes. And I've got to tell you, this is the most frustrating slide that I can deliver because quite often you don't have the conversation with someone until they get here and look backwards. It's very difficult to have the conversation at this point and talk to them about going forwards because it's an emotional asset. People think they can get on the internet and just buy real estate because it's really easy to do. But there's a real art in doing this. And Kate has a particular skill set in being able to find what an investment grade property is. So she's confident that she can outperform given, well, she's very humble, so she won't say that. But given the choice between two properties, she'd be able to tell you which one it makes for a better investment grade asset, which gives you the better chance of getting these sorts of returns. So my point here is we offer a fee-for-service arrangement where we help our clients buy investment properties so that they can set themselves up on a better trajectory. But the problem is our competitors charge nothing. They do it for free. And often there's lots of really strong hidden commissions that are packed into the purchase price. So again, this is a really frustrating slide, but the point is asset selection is crucial. For investing, there's ABC of investing. It's all about asset selection, borrowing, and cash flow management. Get those three things right, chances are that you'll do very, very well. So here's a bit of a framework that we adopt. So as a research committee within our group, we talk about what states and what suburbs we should be considering. And from there, we then determine which streets and which sorts of properties. And is it a house best in this street? Is an apartment best in this street? Or is it something else that's best here? And then we have an investment committee. And this is the point where I think that, Kate excels over and above just the general person because her ability to do due diligence on a particular property is very, very strong. And then it comes down to negotiation. If you don't negotiate all day, every day as part of your job, chances are you will get out-negotiated when you're dealing with a real estate agent. The good ones make it an art and they make sure that they're very, very good at it. So there's a bit of a property selection framework that you can adopt. It's what we do to make sure that we're putting ourselves in the best chance of getting the best results when it comes to buying these investment properties. So the tip here is look for something that has some scarcity value, that's investment grade and has owner-occupier appeal. Now, owner-occupier appeal is very, very important. What's the alternative to owner-occupier appeal? It's investor appeal. And the problem is investors buy with their calculator and owner-occupiers buy with their hearts. So you want to buy something that has some heart component to it. Because you ever been to the auction? Kate will tell you 100 stories. I've done it myself. When we go to an auction and we do everything we can to professionally put other people off from bidding against us. But every now and then someone comes along and they just have their heart set on that property. No matter what, I'm just going to buy it. Logic goes out the window. They probably set themselves a limit and they spend a little bit more. That's the type of property I want to buy. Because remember when the valuer comes along and he has a look at your property or she has a look at your property, I want them to compare that to other owner-occupier properties within the 1 kilometre radius where someone has put their heart into it and they've driven the price. So that then I get a better valuation on my particular property. And obstacle number 7 is they don't develop a reliable blueprint. This is interesting. If you set a goal, 6 to 8% chance that you'll actually get it or achieve it. If you write it down, it increases to 25 to 30%. If you share it with someone else, so the point where you go, well, okay, I'm going to commit this and share it and they can make me a little bit accountable, it jumps up to 55 to 60%. But if you have an accountability partner, boy, oh boy, does that change. It jumps up to 85%. And I know that because I've got this trainer that trains me a little bit, try and keep me a bit fit. And I know I'm pathetic when it comes to committing. I mean, anyone know what I mean? Has anyone got a gym membership where they haven't actually had a chance to go? Because I'm like that. If I had one I didn't have an accountability, I'd never turn up. But because there's someone there who's ready to make sure I'm there, I go. And so I think that the important point here is if you have an accountability partner when it comes to sharing your goals, when it comes around to finance, chances are you're going to have a better chance of achieving it. Begin with the end in mind. Develop a detailed plan that models cash flow debt, investment performance and equity, as well as some future provisioning, and stick to it. So if we go back to the original slide, I think the question shouldn't be about how many properties do you have, but it should be how many do you need to retire specifically for what you're looking for. And I think that's a beautiful, I guess, segue into what Ben and Michael will be talking about next. So it's not about how many properties you have. It's about what's your goal, what are your personal circumstances, and therefore how many properties do I need to actually achieve that.